Welcome to Central Bank Central. I'm Kathleen Hayes. Well, today, a delayed January jobs report, usually out on Friday, this week out midweek because there was a concern there was going to be a mini government shutdown. It didn't happen. And now the numbers may be very much worth waiting for, stronger than expected. So I'm very happy to welcome back to Central Bank Central, Kathy Bostjancic. She's chief economist at Nationwide. So Kathy, let me tell everybody again what the numbers were. Drop in the unemployment rate, 4.4 to 4.3. It was last lower 7 months ago. Job gains, this is really a surprising what payrolls, right? 130,000. And the private job gains up 172,000. So what do you think? Is the economy dodging a bullet?
Well, Kathleen, always great to speak with you. As you said, the headline reading and even the private payroll gain in January was a pleasant surprise. Our estimate of what break even is each month, just to keep the unemployment rate steady, is 50,000. So the fact that we created almost three times that amount, it really speaks to how strong of a report. And keep in mind that break even rate is lower because we have demographic change, aging of the population, and importantly, last year or so, change in immigration policy. But one thing we're careful about is not putting too much weight on one monthly report, especially since January is chock full of all technical adjustments that they'll make. There's the benchmark revision, which is actually last year's data, like it goes through um, uh, April 2024 to March 2025. That was revised down over 800,000 jobs, but we knew that. The preliminary estimate was close to
Right.
that. But then you get the revised birth, death, business formation estimates, and that picks up where that benchmark leaves off. So that goes from April 2025 through December
Okay.
2025. So what happened is if you add both those revisions together, the level of payrolls as of December at the end of last year was over 1 million less jobs. So that's quite a significant downward revision, right?
Right.
And it left the payroll growth for 2025 at 181,000. That's only 15,000 per month. Now that's all old news. It's not a complete surprise, but the reason I bring it up is, and in addition to those benchmark revisions, we also get seasonally adjusted figures. Now we could have also gotten population control adjustments for the household survey. They
Wow.
delayed that because of that, partial
Okay.
government shutdown. So it could have made the data even a little messier. But I think that's why we have to say, I think it's a good reading. I think it kind of comports with our view that we're past peak uncertainty and the job market's
Hmm.
turning and
Okay.
firming. But I just don't know that the 130 is the real new pace of
Okay.
job growth. Probably a bit less.
Okay, well, and even so, it's like there's been all this, oh my God, all last year was how weak the jobs report is. Well, it's because the natural rate, the amount of jobs that can be produced at a time when you've had deportations, immigration, et cetera. It seems, are we kind of I think are we turning a corner, do you think? Maybe not like, oh boy, all of a sudden the economy and the labor market just got really strong in January, but that we've seen the bottom, the weakness there, and maybe things are picking up again.
Yeah, we think so. And we saw signs over the, past prior months, even with the downward divisions, that you saw private payrolls was firming. What happened is we really stalled out over the summer, and that followed the Liberation Day, right? So that was the shock, right, of the tariffs, rate uncertainty, peak uncertainty. We're, away from that now. So it doesn't mean that uncertainty is back to normal, but it's certainly not peak uncertainty.
Okay.
It's not peak
Okay.
uncertainty.
We're gonna have normal uncertainty. I like that. But what about the government job losses? 62,000 in January. Their net government job losses over 3 months, 6 months, 12 months. Do you think they're going to continue? What does that mean for the economy?
So I think at some point they're going to level off as well. But you are still seeing the impact of reduction in payrolls at the government level, right? Whether it's Doge or other cuts that they're trying to impose. So I think that kind of does level off at some point, becomes less of a drag, but we don't look for job gains at the federal or even state and local level, to be honest. I think it's really going to be led by private sector. And keep in mind, the One Big Beautiful Bill Act not only gives a lot of incentive to invest, but I think it also frees up capital for companies to start to hire as well, going forward.
So, Kathy, I want to ask you about some of the specific job categories. Health and education jobs dominated gains by 137,000, right? And that's one reason people have been worried over the past several months. Well, health and education, that's dominating the gains, right? You need to have a broader, stronger labor market, right? Professional services jobs, though, this time gaining 34,000, trade and transportation down 6 months in a row. How do you break these down?
Yeah, so as you said, it's still predominantly concentrated in healthcare sector. There's a secular need for workers in that sector, so it's not going to go away. But what we're seeing is some green shoots of it broadening out, right? Construction employment was up in January, up 33,000. As you indicated, there was even professional related jobs up in the service sector, and temp workers have firmed up, and that tends to be a leading indicator for the labor market. So I think what we're looking for, again, we're not looking for an overly robust job market. Again, I think the 130,000 probably overstates the monthly gains we're going to get going forward. But I think we do get some firming and broadening out, and I think that will make the labor market healthy. That said, probably healthcare is still going to be the leader.
Okay. What about the weather? Will the cold snap, for example, glad it's starting. It seems like it's starting to end finally here in the
Thank
Northeast
goodness.
area. Fingers crossed, yes. But will that hit the construction jobs in February? The weather impact on January was low. Uh, on jobs, in fact, was low. I mean, the third lowest for January in the last 11 years. Will that proportion rise in February?
Yeah, I do think we're going to have a weather impact in February. The data is collected the week of the 12th, so we're still in that, the cold snap is still extended into that period. So certainly we could see some of that. And we'll have to keep that in mind when we interpret the data. Probably also get a chill on, consumer activity and spending to some degree, right? We could still purchase things online. Maybe some of that shifted online, but I think a lot of people were hunkered down. It was pretty cold here, large parts of the country, and with the snow. But I think overall, if you get the improvement in the labor market, we think you've got tax refunds that are at least 50 billion higher than last year. And I've spoken to friends who've actually gone ahead and did their taxes. I'm woefully behind. But
Me too.
they've been pleasantly surprised, right? So especially if they're affected by the SALT increase, right? And that's allowed under the One Big Beautiful Bill. So bottom line, you get these tax refunds and also reduction in taxes for consumers and businesses beyond that. And you get labor market. Listen, we only need to do better than 50,000 per month, and
Yeah.
3 month average is 73,000. If we can maintain that, that's a pretty strong backing for the economy.
Average hourly earnings, speaking of people looking in their pocketbooks and deciding how much money they're going to spend, for non-supervisory workers, that's like, the people who work on the line, right? Up 0.4% in January, up at a 3.2% pace over the last 3 months, 3.8% over 12 months, up about roughly 4%. So is that acceptable to the Fed in terms of inflation and its 2% inflation target?
Yeah, that's a great question. So first, I was just going to point out for the workers, although it's not always picked up in the surveys, we've seen real wage growth for quite a while now. Right? You just take that nominal wage number, you cite it, subtract 2.5% for inflation, so you've got positive wage growth. Now it's not necessarily distributed equally across all households. Um, from the Fed's perspective, I think today's data and the wage data just reinforce the idea they're on hold for a while. But we do think like the longer trend in wage growth, and we saw this in the employment cost data earlier this week, is downward. It's a gradual downward trend. And I think that does help some take pressure off of inflation, and especially the service sector. So we're optimistic that inflation peaks somewhere in the Q2. I think it came down quite a bit at the end of last year, but that's due to the technical adjustments they did because they couldn't release the October data. They threw in a bunch of zeros. Once we're going to get a pickup acceleration year on year as we go into the early part of this year. But if we're right and we peak, the Fed could still be cutting rates. And we still hold on to our view of two rate cuts in the second half of next year.
Okay, not till then. In other words, giving that inflation dynamic that you expect other people are talking about it too, let that unfold. So what about the CPI? We're talking about the jobs report, but just because we were on some of these inflation issues, what are you looking for? It's now that we knew who the Fed chair nominee is, I feel like some of the inflation question doesn't seem quite so heated up, right? But it's still there. So what are prices going to start looking more behaved now? Do you have any, this is going to help it push up, that's going to push it down?
Yeah, so I think for January, I think we're going to see upward pressure. We talked about the weather. I think natural gas prices, electricity prices are going to push up the headline reading, even though gasoline prices seasonally adjusted are lower. So we're looking for 4/10 headline increase, and we think the core reading's up 3/10. So it's a bit firm. We think that it's the beginning of the new year. Companies try to pass through price increases. Some of that's maybe even related to the tariffs, but it's also a normal January effect. Seasonal factors should adjust for it, but they don't usually fully. And there's something called residual seasonal factors or seasonality that we deal with. So that kind of supports the idea that we get this little acceleration in inflation. I don't think it's too worrisome. And as you mentioned, if all goes as expected, we will get Kevin Warsh confirmed as the new Fed chair, and he's going to be inclined to lower interest rates as long as the data don't strongly argue against it. So I think that we'll have okay labor market data, but we'll have better inflation data, and we'll give them room to lower rates.
As an aside, I just have to say, um, uh, first of all, if the data permit, a Fed chair should lower rates, right? And it seems
Yes.
to me that no matter who was nominated, everybody be well, of course, X is going to lower rates now, right? So, but it will be very convenient for everybody, I guess, the nominee and the person who nominated, if the data open the door, right? Then it won't be such a contentious kind of thing. But I want to ask you something that's a little more nerdy, but I think people, it's worth for people to know, worth it for people to know about is what I'm trying to say. Hours worked. That's a combination of people working, the number of people working, and the hours they work. They reversed a December decline. And now they're up zero point 0.4, 2.1% pace over 3 months and a percent over 12 months. So what does that tell us about labor market growth and strength?
Yeah, it just supports that narrative that the labor market, has troughed and is starting to pick up. You're seeing that both in the number of people and then the aggregate hours, as you said, it's the number of people times the change in the work week. And I would go further. I would, if we add in the average hourly earnings, so we talked about, there's something called average weekly payrolls. That's the combination of all those factors. It popped. It was up 8/10 on the month. So that means it provides a nice underpinning for wage growth in the month of January and income, which can be spent along with the tax refund. So really does give a nice underpinning for consumer spending.
Jobs diffusion. We were just talking a couple of minutes ago about the concentration in health and education. But another nerdy thing, the breadth of job gains across non-farm and manufacturing industries now over 50%. Is it getting we're getting broader, a little more solid, not so concentrated? And is this a number you don't doubt? In other words, well, it's because it's January and what happened last year, or do you think this is possibly something showing once again the labor market's getting on better footing?
I think it's a great point. it does provide that view that it's supported that view that it's broadening out a little bit and is encouraging. And I was looking at that as well, both for overall payrolls and private. So I think that's the theme that we're expecting to play out. Again, healthcare is still going to be dominant, no doubt. But I think if you start to see that broadening out, that's really encouraging. I think, companies got sort of paralyzed last year, like not sure what
Yeah.
different policy, what's the tariff rate, what's going to change next. I think they've learned to deal with that and cope. And I think we should also add that productivity growth is still going to remain strong, although if you start to see employment pick up, it could be that you also get a more balanced growth profile. It's not just all coming from productivity. Essentially, most of the growth last year came from productivity. What you'd like to see is the economy creating, jobs, new jobs, and we have productivity on top of that.
So, how do you think the Federal Reserve's going to read this report? They've got some more weeks before the next meeting. A lot of people are expecting them to stay on hold for a while and let the impact of the three consecutive job cuts, excuse me, rate cuts, um, work their way through the economy. Uh, but what are they, if you're sitting in your office at one of the Fed regional banks, or you're in DC at the Board of Governors, what do you think you're saying to yourself?
It's an interesting time because I think today's data um, kind of has a little bit for everybody, but it particularly could still embolden the hawks to say, see, this is why we didn't need to cut rates again. Look at the job market is starting to boom, and look at wage growth. I'm a little worried about that. If you're a hawk, I don't want that to start to pick up. And so I think it just, kind of confirms that the Fed is on hold for a period of time here. Um, and I think the Doves are going to say, well, let's wait and see, though. Let's wait and see. And they're going to point out some of these idiosyncratic factors that probably boosted, the January reading. And they're going to argue that, well, we still think inflation will start to trend lower in the second half of the year. So I don't think things change. Maybe it hardens the line, actually, ironically.
Yeah, yeah. Well, I love debates at the Fed. It's very interesting when you see all these different views. And that's what it's supposed to do, right? I mean, I think people work about central bank independence, Fed independence, but ultimately, these are what these people do, and this is what they're used to. Just leave them alone, and they'll do it. But and quickly, also retail sales, they were, let's see, they're kind of flat. Is that just the ups and downs of the retail sales report? Also, the fact that the first count on retail sales is preliminary, right? And you get revisions, weaker or stronger. What do you see there?
Yeah, that's a good point. When I saw the December data, I mean, it did come in softer than we thought, but we had such a spending spree in October, November.
Yeah.
It's not surprising to see the consumer take a pause and remember a lot of that spending was fueled by driving the savings rate lower. I think in part due to the wealth effect. People feel wealthier, equity market keeps rising. They feel we don't have to save as much. So there was a little bit of pause, but when I look at these income numbers for January and know the refund checks are coming, I think we're going to see the consumer kind of refuel here for the first quarter.
So, in terms of the other aspects of all this, looking ahead, I love to watch the Atlanta Fed's GDP Now survey, right? They track data all month long and they keep adjusting it. And it has been so strong going into the end of the year, right? It was like, oh my God, how could anybody think any more rate cuts if you're seeing what the GDP is, what growth is doing, what it's expected to do? I think it's still at 3.7% for the fourth quarter right now, or last quarter, I should say. So, what do you make of that kind of number? Do you think that that's where the fourth quarter is going to come out? And do you see the same thing happening now in the first quarter of 2026?
So our forecast is pretty close to what the Atlanta Fed has now. We have 4%. We've had that for a bit. The but we always benchmark our forecast. We take a look and see what the Atlanta Fed is doing. Um,
Sure.
I think that for first quarter we're tracking a bit lower, but it's because trade, the net exports is not going to add as much. So what we had was because there was so much volatility and adjustments in the trade sector due to the tariffs. What you ended up seeing in the second half of the year is particularly fourth quarter, huge positive contribution from net trade because imports really collapsed at one point. Um, we think that trade's going to be a slight drag. We still think the consumer is going to be quite strong. CapEx, right? So AI CapEx, eye-popping, right? These numbers we're seeing. I mean, we could see non-residential investment add another 1%, what 1 percentage point to GDP growth in the first quarter and for the year. It's just that strong.
Wow.
Yeah.
So let me ask you then specifically, what is your, let's say you're at Fed and you have to put in your forecast, your dots, right? What would your dots be for in terms of the SEPs, I should say, the summary of economic projections, if you had to put down, okay, GDP, inflation, unemployment.
So yeah, so for GDP as a whole, we have growth. It's still quite solid and positive. We're somewhere around 2.3% Q4 over
Hmm.
Q4. That's how the Fed reports theirs. I would say there's upside potential to our forecast, especially if this labor market continues to outpace our expectations. I probably will be compelled to push that up. You've got that will fuel still strong consumer spending. And then when we add up again with the AI CapEx numbers that have been announced, right? They alone add, like for the full year, probably 6/10, 7/10. Now we also have to offset. So this is a little geeky, but you have to offset some of the AI related equipment we import, and we import quite a bit. So when you offset it, the net impact on GDP is a little muted. That's probably why we don't have like a 3% GDP growth number, to
Okay.
be honest. But domestic demand, if I'm just looking at domestic activity, it's going to be pretty strong. It's probably close to 3%. And so unemployment rate, we have 4.2, so we think that continues to trend lower. And inflation, we have for the personal consumption expenditure right around 2.5%. So I
Wow.
think pretty in line with the Fed. So it's still above 2%, but the key is it's coming down. And I think that's where they get that they want to look ahead and they get the room to be able to cut interest rates. And I think, even though, why the question I guess would be why, well, we know there's a political considerations of why everyone thinks the Fed's going to cut rates. I guess absent that, there could be more of a debate, should they really cut? But I do think you'd like to see broader growth. I mean, I think the one thing that we still see a little bit of vulnerability, it's both the strength and the vulnerability, is so much of it's concentrated in upper income household spending, AI related spending, and even within the job market, healthcare. We need to see things broaden out. And I think if that happens, you'll start to see big improvements in the sentiment and confidence readings too.
Okay, you mentioned AI and AI is expected to do so much productivity, et cetera. When it comes to job creation, where is the most job creation though right now? Right now, is it more in the construction and all those areas where you need people to come in and help build these centers, whatever? Are we waiting to see actual job creation directly from AI? I mean, there's already people working in AI companies and making tons of money, right? If they're doing a good job. But I think when you look at, say, you see reports, papers about college kids and what's going to happen to them. So as somebody who's an economist and also somebody who knows people, involved in all this, what do you see, Kathy?
Yeah, great question. So there's strong cross currents here, right? So trying to disentangle it. So we're pouring through a lot of data, to be honest, right now, birth survey and other data and matching it up with the BLS sectoral, their projections with employment. They do projections out 10 years. So we're trying to map that. It's quite a bit of work and pretty tedious going through that. But I think, you know, it's still early in the game, but I would say that there will be some disruption. Some workers will be disrupted. Some will be augmented and see improvement in productivity. I think the vast majority. And I think for the new worker, the young workers coming into labor force, I have a son who's in college. I've been telling him,
There you go.
learn AI. So he's studying economics and finance, but I said, learn AI, learn to have the skills that the employer is going to want from you coming out. He's also telling me his friends, and even he's toyed around with doing something on his own, like and using AI, and they do this marketing, online marketing things. So, the young kids, we can't undersell them. They're pretty savvy, and but that said, it's a different world. So I think we're all trying to navigate and figure out how this is going to play out. Um, we'll see if it restrains employment going forward. We'll also find out, again, our forecast 4.2. I've talked to many people and say, oh, you're way too optimistic there. There's going to be more disruption, and I think unemployment rate is going to rise, especially in like the financial sector. And we've already seen the IT sector. So I'm I would acknowledge that that's a potential there too. We could have strong growth and maybe we're a little too rosy on the labor market, and maybe again, too much of it's coming from productivity growth. Again, productivity growth is never a good thing, but what we want is both the labor market and employment, you know, booming or picking up. So we'll see. To be honest, we're doing more intensive research and going through all the details to see, indeed, to test that thesis. Are we too optimistic? It may have also take time to play out, right? That's the other thing.
Yeah,
Maybe it's not this
definitely.
year, maybe it's next year.
Okay. Well, when you get that report done, come back. You
It
can
will
share it with
do.
us.
I would happy to
Okay.
do that. Yes.
Okay. Well, Kathy Bostjancic, we're always happy to see you on Central Bank Central. Kathy is the chief economist at Nationwide. I'm Kathleen Hayes, and this is Central Bank Central.